We then bolted Laos onto the Cambodia fund, rebranded and relaunched it as a Cambodian Laos fund, and concurrently launched a Mongolia-focused fund called the Mongolia Opportunities Fund, and repositioned the whole business as an extended China resource play. So that was the only way we could get traction back with investors, because in the throes of the financial crisis, no investor looking at Asia would look at anything beyond China. But also during that time, it was Mongolia that got a lot more interest because of the resource game and the high GDP growth of the country. So we managed to close the Mongolia Fund last year with the IFC, the EBRD, Mitsubishi Corp, and various other developmental institutions and high net worth investors. It's a $50 million fund that's focused on anything but mining. It has had to target very high returns because investors expected that. And so we've just started investing in Mongolia early this year. And then in Southeast Asia, we found it a big struggle to get a Cambodian Laos fund off the ground, because since the financial crisis, attitudes of investors towards smaller single country offerings has totally changed. Back in 2007, 2008, as long as you had a good idea, it sounded sexy, investors would say yes, they will back it. Right? All that has changed. Investors have become incredibly risk averse. The process, fundraising environment is as tough as it's ever been. So what we had to do with Cambodia and Laos was reposition everything. We joint ventured with a group in Vietnam, a fairly established group called Dragon Capital that manages about $1 billion. It's 10% owned by the IFC. They had similar problems trying to get a Vietnam-focused fund off the ground. So it's only when we put together Cambodia, Laos, and Vietnam and repositioned it as an Indo-China story that investors came back to the table. All right. All along, the ethos of what we do is that we wanted to go into frontier markets because there were very compelling investment opportunities in these countries that had potentially very high returns. We work very closely with developmental institutions. You know, we're signatories to the UNPRI. We are fully ESG compliant. But what investors at the end of the day, what we found with investors at the end of the day was that all they cared about was returns. Right? We used to have a line in our term sheet saying 10% of our fees once we got to 100 million, 10% of our fees and 10% of our profits would go into a foundation which would be used, and the foundation would focus on the countries that we're investing in to set up sustainable ventures, build capacity. Well, we realize that investors don't really care. Right? It's a very nice to have. They always say it's very nice, but ultimately, in order to attract money to the frontier markets, you have to demonstrate that you can provide them adequate returns. So that's where we stand now. We're raising a $250 million Indo-China focused fund. We've got quite a lot of interest because it's arguably the most overlooked and undervalued region within Southeast Asia. And with Myanmar coming on stream, there's also a lot of interest in this most exciting new frontier market. So basically our fund would look at across all these countries. In Vietnam, it's largely in the consumer space. In Cambodia and Laos, it's largely in sustainable agriculture, infrastructure, and we're still trying to figure Myanmar out, but chances are we'll be looking at logistics first and foremost.
Thank you very much, Marvin. And I think Marvin articulated some candor in terms of what investors are and aren't looking for and where their priorities lie. I guess the question that I have for you, Marvin, is if investors really, push comes to shove, they care about returns. You're the one who is managing the companies or the social enterprises. How do you, as someone who has a passion and concern for social development, ensure that at least all of the portfolio companies are being developed in a sustainable and responsible way?
Well, thanks, Raya. Now, we are, our anchor investors are the IFC. We are also signatories to the UNPRI. So when we invest in companies, what we take a semi-active role. We're minority growth investors. We take a semi-active role. We'll sit on the board And very importantly, we'll install our own financial controller or CFO just to make sure that the money goes to where it's supposed to go. So in terms of ensuring that our investee projects or companies are ESG compliant, it's largely through the board level, and also by having teams on the ground. Frontier market investing is not a fly-in, fly-out business. You have to be physically present on the ground. You have to hold the hands of your investors, and you have to watch them. Right? So it's only with careful monitoring that we can ensure that that international best practices are introduced, there's corporate governance, and all the right things are being done. And also, we work very closely with developmental institutions, so we have to do that. And when I say we work very closely with developmental institutions, what I mean is that they are investors in our fund, but at the same time, we work very closely with them to catalyze debt financing for our projects in countries where debt financing is not readily available.
Thank you. And may I introduce Reshma, who actually I think is a follow-on conversation to what Marvin was saying, has come in recently to Leopard Capital, which was started really purely as a frontier markets fund or set of funds. And she has come in as the global ESG head for Leopard Capital, focused on impact investing. So she is in charge of integrating the environmental and social management into the investment process and cycle. She leads Leopard's efforts to pioneer new approaches to impact investing in frontier markets, including their first impact-focused fund, which is a Haiti fund, which is going to be launched in the next month. And she also oversees the future technical assistant facilities to provide some of the capacity building that we've talked about is typically needed for the portfolio companies. Reshma has an MBA from MIT and an MPA, a master's of public policy from Harvard Kennedy School. So Reshma and I had a conversation last night, and she was saying, surprisingly, just as a matter of best practices, some of a chunk of what Leopard was doing in investing in these frontier markets was already impact investing, or was capturing a number of those metrics, whether it's what the IFC puts forth, or some of the other ESG type statistics that we put out there. So Reshma, if you would kind of give us an overview of the work you're doing on the ESG side.
So I came in last year. I've been there about a year. Leopard Capital is a frontier markets GP. We started in Cambodia. Our first fund was in Cambodia. Also, like Marvin, we started in 2007, launched during the financial crisis. So we ended up raising the first fund from over 100 retail investors. Not very sustainable in the long term for our future funds, but so the fund itself didn't have an impact focus or ESG standards per se formalized. When I was brought in to formalize our approach to environmental and social standards, as well as look at how and whether we want to position any of our funds as impact investments. What I found when I was looking retrospectively at our investments in Cambodia is that not only, if you're investing in frontier markets in growth sectors, they're really kind of developmental sectors. There are financial services, rural telecom and rural electrification. There was some agro-processing. We started a shrimp processor. So there was a lot of impact in our investments as it was. When I started looking at the environmental and social standards applied, they said, oh, we didn't do anything. And then when I really asked specific questions of the investment managers, they actually did. I asked them about one of our companies, what the emissions standards, do they have any idea? They said, oh yeah, and they just pulled all the numbers out. When I really dug into some of the internal documents, operational documents, there was one company I was concerned about labor standards and child labor. And in the documents they said, we're having a strict policy on child labor. Labor standards have to be really high. It doesn't matter what they say. We have to do that. And IFC is now, they're going to become an investor in Haiti, and we've talked to them about it. And I was nervous because both in Cambodia and Haiti there's issues. So I was nervous about really try to broach that subject with our companies or our investment staff, but the fact is a lot of them were already aware and doing it without any external push. So now my role is to formalize our process for environmental and social standards in line with the IFC performance standards, as well as in Haiti we've decided to also formalize our impact investing approach. And again, in Haiti, it's the sector focus is almost naturally aligned with an impact investing focus, because what Haiti needs is the growth sectors again are the ones that are going to have the most impact. So agro-processing, renewable energy, affordable housing, and tourism, those are also the sectors that are aligned with the government priorities for the country. And in Haiti, you know, so it's interesting because when I started looking at the impact investing dialogue, where do we fit, you know, I think a lot of it started in Western markets. And I'm not sure if the conversation has really caught up to what's happening in, I mean, it's a little bit in emerging markets, but frontier markets is a completely different story. And I think I'm looking forward to when the dialogue does catch up, because I think, you know, some of the dialogue is environmental and social standards are not impact investing. Well, when you have, you know, good government laws and regulations in place, that may be true. But in these countries, it's very, very difficult to, they don't even, I mean, if you try to bring it up, they don't even understand. I remember a potential investee, I talked to him about, you know, child labor and other labor standards, and they were like, they just looked at me like I had, you know, 3 eyes. They said, what do you mean? That's like how, you know, they thought I was like a Western person coming in and trying to impose, you know, we had this whole argument about culture, and they thought it was culturally inappropriate for me to ask them that. So, you know, it's a huge hurdle, and I think a lot of, maybe other investors aren't doing it, I'm not sure, but I think getting, you know, labor contracts in place and getting, you know, labor standards, occupational health and safety standards, those have huge impacts, because they can also have an impact on an entire industry depending on the investment you're doing. And then the other thing is, so I'm trying to kind of balance the, you know, IFC's needs for environmental and social standards with potential impact investors who are looking for different metrics, and figuring out, trying to map where those align and where they don't align. And what I'm finding is that actually, so I've been looking at GEARS. We're going to be using GEARS for the Haiti Fund. When you map the two together, in some ways, the IFC performance standards go further than the impact investing standards. And then there's some things that are missing that we would need to add. But I think some of this dichotomy between responsible investing versus impact investing, and, you know, commercial versus non-commercial, I think we've all been saying, is we need more commercial entities people that are more commercially focused. In Haiti, they call it the Republic of NGOs. There's a, you know, a parallel economy, and same in Cambodia. There's a parallel economy that's driven all the prices up because of the international NGOs that are there, and they don't need any more charitable money. They really need private sector investors.
Sorry, I must just add a comment that one of our employees said to me the other day. He said that the NGOs in Kathmandu are the Wall Street of Kathmandu. Everybody aspires to work for the NGOs.
You might want to tell the folks on Occupy Wall Street that. Reshma, if you could kind of give us a sense of the investors in Leopard Capital, because you kind of, it seems that come at it from a different side. You didn't start with necessarily an impact investing focus. You started very much with a for-profit frontier investment focus, and have found your way more into the impact investing, albeit impact investing may not have necessarily been a formalized term when you guys started. Could you give us a sense of what your investors are looking for in terms of both financial returns and impact, if they are? And we'll start with that. Thanks.
Yeah, so right now we've decided, you know, I think we've, you know, everyone's echoed that it's very difficult to raise money in these markets, and each market is slightly different. So Cambodia, we were able to raise a fund from retail investors who just care about commercial returns. In Haiti, what we've decided, because there were different funds that we were going to launch, people said, yes, we're interested, and then they changed their mind and we spent a lot of money and there's no funds. So what we've decided is, going forward, we'll probably have, as Armin was saying, anchor investors that were DFIs, because then other investors will likely come in after that. We've gone through their due diligence. You know, they know that we've got a solid base. So right now, you know, Haiti, for instance, it's IFC, FMO, IDB. and then we're looking at the next layer of who the next round of investors would be. Of course, we're still approaching other DFIs, but we're just starting to talk to impact investors and see what they're interested in. In Haiti, it's going to be really, so, you know, in Cambodia, you may be able to get commercial investors. In Haiti, I think it's almost impossible. I'm not sure. I think, you know, we'll probably, our best bet is diaspora, who have been there and understand some of the private sector opportunities, but I think other than that, we're probably going to be looking more to impact investors and diaspora. So I think that they're going to want an impact story, but I think, you know, Haiti does need commercial returns. I mean, you know, everyone's banking on this being a commercial fund. That we kind of, you know, our CEO Doug, who was supposed to be here, he couldn't be here, but you know, he says it's our obligation to change perceptions of outside investors, you know, for the outside of these countries, and it's also our moral obligation to do good while we're there, because there aren't government regulations regulating these things, and so we not only, for the people, have to make money for them, you know, make money, but we also have to do good by them. And I think, you know, it's not as hard to do. You know, I kind of disagree with Armin about the deal flow. I think, as Marvin said, you know, if you're on the ground, there's a lot more deals to be had. It's just when you're trying to invest, a lot of, not all, but a lot of impact investors are investing from Europe or US, and it's not as easy to find those deals. When you're on the ground, people come to you, you hear about things. So I think there's a lot more deals when you're on the ground. We heard from some DFIs who weren't as aware of Cambodia and Laos. They had been told, you know, you can't do equity in Laos and Cambodia. There's not a lot there. And when we were telling them that we saw deals between 5 and 20 million, they were shocked because they had never heard of that. You just have to, if you're there, you know, it's much easier to do it.
Thank you. So I'd like to introduce David, our final panelist. Apologies for getting to you a little bit later here, David. David Finneran is founder and director of PT Manaka Sales, which is an inclusive business company in Indonesia in the areas of clean energy, fisheries, agroforestry, and energy efficiency. David has really been working with companies and investment firms, advising them for 20 years in Indonesia. He chairs the Corporate Citizenship Committee at the American Chamber of Commerce there, and he is an occasional advisor to the IFC and World Bank, and is currently working with the ADB on their inclusive business funds and creation of those. But David, I would hope or would like to ask you if, as more of an investor, just an owner of a business, if you could give us a specific example of a single investment and how you found were able to get the impact out of that, the social or environmental impact, and then maybe a sense of financial returns on that. Thank you.
Thank you, Ryan. Good afternoon, everybody. Keeping in the mode of this frontier theme, I guess, the example I selected was something we decided to pioneer in the biofuels industry down in Indonesia back in 2006. Taking a lead on that for a couple of good reasons, actually. There was no biofuel production at all in the country, and obviously no competition. We were aware of, after a global due diligence search, of some very appropriate technology, which is modular and automated in design. There was a great opportunity to displace an awful lot of the diesel imports going into the country, as well as reduce carbon emissions, and an obvious option to also export the biodiesel production later on if the local demand was not enough. So some of the drivers in terms of why we decided to do that, there is even at that time, there was an increase of different mandates for different countries to take on biofuels in terms of blending in the countries, Europe, US, and different parts of Asia as well. There were a number of financial incentives, import duties, VAT, withholding waivers, income tax reductions. There was also availability of both non-edible, at least we believed at that time, and edible feedstock sources with plenty of palm oil. We ended up doing a pretty in-depth due diligence study to India as one of the first investors of D1 back in those days, and spent 8 days going, from 8 in the morning till 8 at night in all kinds of different directions with a number of different hosts, and we did not find one viable example of what is called castor oil, or Jatropha, way back in 2006. So we knew that was a wrong steer, so we ended up, unfortunately, with an edible feedstock, which was not really part of the original plan, and that was crude palm oil. In terms of how we did, we got up to production in 2007. We did become the first actual biodiesel producer in the country. Our modular automated unit was only 20,000 tons a year. The government of Indonesia was very late in terms of establishing its own mandate. There was also and continues to be an awful lot of inaction in terms of fuel subsidies, whether it's more fossil fuel or continuing fossil fuel or new subsidies for the biofuels. So we had a couple of serious challenges there. We ended up then having to deal with the crude palm oil, as I mentioned a second ago, but this was before the Roundtable on Sustainable Palm Oil in terms of having their standards and criteria in place for testing. So we drew up our own checklist based on what was available at that time and did the best we could. In terms of how things really went and some of the challenges and lessons that we learned, you know, there's an awful lack of coordination that continues in Indonesia with the government and the government agencies. They're a little behind on their green energy roadmap today. The lack of coordination between different agencies, Ministry of Finance and Pertamina in our case. Pertamina is supposed to be the outlet for a lot of the biodiesel in the country, but Ministry of Finance wasn't reimbursing them for taking the chance to put it out to the public. And of course the mandates and the subsidies that I mentioned. So we've learned to very carefully in our future investments since then not to be too dependent on the government of Indonesia in terms of their intervention. Escalation of palm oil prices put us in a pretty bad place in terms of thinking long term. As many of you probably know, you need to secure your feedstock raw material or you're going to be in trouble. And the prices started to shoot up very significantly in late 2007, 2008. So this put us in a pretty tough spot, and then there was also this emerging food versus fuel issues, which has continued to grow. So we continued to carry on, but for a number of different reasons there, we just really weren't able to grow the business to the 200,000 tons a year, which was our projections. We ended up selling the company in 2009. We got 3 times our money out of it, but it was a lot less than what we had expected. And some very good lessons, and really taking that a little bit further, we're continuing to be very committed in the biofuel space in Indonesia. Again, modular and automated, but we're going into biomass gasification from 50 kilowatt to 2 megawatt, so we can create our own feedstock with communities and community development programs with waste materials in the community, or planting 10 hectares of bamboo, and we're off and running. So some nice social aspects, some nice environmental aspects this second time around with a little bit different technology.
Thank you much for sharing that, David. It sounds like there is a match perhaps between the investor's focus on financial returns and the commercial necessity of success first. And then the social impact to some extent, or the political impact, is up to you as individual firms and you know, almost good citizens to use good practices and invest in a responsible way. So with that, I know we probably have about 10 minutes. So I'd like to open it up to questions from the floor if anyone has one. Please go ahead. There's a microphone behind you, or if you speak loud enough, just please stand up.
My question is for Armin. You mentioned that I mean, it's great to know that you're spending a lot of effort in terms of impact assessment tools and stuff, but also you mentioned that that's not even looked at even before 8% is returned from the future investments that are being made. My question is, when you pulled in money from private sector investments, are you actually doing the scanning in terms of whether they are impact investors or they're just regular old-fashioned commercial classic investors? That's number one. And number two is that you know, when you are particularly choosing these regions like Mekong regions and India, Bangladesh, and all these other regions, same principles apply in terms of how it is evaluated? Thanks.
So directly, I want to collect some more questions.
No, go ahead.
Okay.
Or do you want a minute? Do you want
I don't know, maybe there are more questions which I will come
Okay,
back.
I see one more question in the back, sir, if you want to go ahead and put your question forth.
Hi, I'm Matt Gamzer from the IFC, and I'll be brief because, as you heard, several of our clients are up in front of you. But I just wanted to make one small point and then ask a question. I mean, we are roughly a $20 billion organization now, exclusively based on private sector investment, and then another 20 of mobilization of other people's funds. And we've been able to do that since 1956 while living off the returns on our investments, so, which have always been in emerging markets, which have basically all been frontiers. So I think there's a strong, long business case that this is good business. And also our biggest single multiple ever on an investment was in a little company called Celtel in that really, really easy market called Congo in Africa, which a guy named Mo Ibrahim started, and we gave him, I think, $1.5 million, if that, and we sold for about $125 million a few years later to another tiny investor, the Dubai Sovereign Wealth Fund, at that tidy little multiple. So, I mean, I think that there's frontier markets can be very good business. I just wanted to ask the members of the panel from the funds. I want to go back to the question. You know, when is it better that you bring the initiative to financiers like us, and when is it better for us to put the package together as ADB is doing? Because we get into both these models, and I'm very interested in your impressions about what's the right time to either go directly and back you, and what's the time to pull you in through trying to structure something as is being described.
Well, thanks for the question. I think it's a bit of both. All DFIs have got an annual strategy in terms of where they want to deploy monies into geographically. So there's definitely both a push and a pull factor when working with DFIs. So when DFIs put out an RFP, if it fits the bill, then we'll certainly try to step up. But at the same time, also from our perspective, DFIs play a very crucial and catalytic role in all frontier markets, actually in all emerging markets. I mean, we exclude China, India, and probably Indonesia these days, because without DFIs coming in as anchor investors, a lot of the other commercial investors would be hesitant to commit to these funds. It's only with DFI endorsement that commercial investors, DFI endorsement, DFI due diligence, that commercial investors feel they take a lot of comfort in that. And as I was saying earlier, DFIs also take a pretty hard-nosed approach when looking at funds and looking at potential returns.
Having been on both sides of the coin with DFIs, I mean, I appreciate, you know, ADB's initiative to say, yes, we have an express interest in these countries, and we've already committed to it, and we'll back it. At the same time, I mean, I think, you know, ADB is a little different because they're not necessarily in the equity game, and so it's unclear to fund managers whether they're interested in doing equity deals and what they're interested in versus IFC, who's had a long history in funding private equity funds. So you just kind of know to approach them. But at the same time, you know, if you're talking about the universe of DFIs, there's a lot of, it's sort of difficult to try to figure out. Each one has different priorities that change continuously. And so while you know, it's nice to be able to just kind of say, yeah, you know, we have this idea, what do you think, and kind of explore it with them and have that flexibility. It can be difficult nailing them down. So if there is a very strong institutional commitment for a particular region or country, it would be great if they would just kind of say that.
Sorry, I just want to be clear also, I'm not posing an IFC versus ADB question
No,
here
I
because,
wasn't either. Yeah,
because we have a history, we have cooperated on funds, especially in microfinance and infrastructure, where we do exactly the model that's being talked about here. So please, IFC does both these things. We do the push and we do the pull. I was just trying to ask about what you think is the right time to push and the right time to pull.
Yeah, and I think, I mean, I agree with you.
I'd just like to quickly address that. It's a live question in Nepal. IFC have been trying to set up a SME fund with Bank of Kathmandu and Bead Management for some time, which I spoke to Peter Tropper recently, and he's hopeful that is going to happen. Whether it happens or not, we're also talking to IFC, and from a structuring point of view in frontier markets, this is a big deal. So if you are pushing, you are understanding the structure of getting money in and out of Nepal or a frontier market in an efficient fashion. One of the issues with CDC at the moment is that they haven't done that planning. They haven't done any pushing. And so there's a whole level of education for the DFI before you can even talk about a deal. So the fact that IFC have been pushing, the fact that ADB are pushing, when the pull comes, the pull is a lot easier.
Perhaps in this context, I think it's for what purpose are you pushing? An impact fund, I think you can push. Our experience on a social impact fund, there is none in Asia, not even one. Yeah? And there was never one proposed by a fund manager. So we are pushing. We are pushing with an instrument, which is an impact assessment tool. We are pushing with corporations, with donors, IFC and others. And we are pushing with a technical assistance facility, which is working, for example, with the government to get framework conditions right. These are things a fund manager wouldn't do. And I think in the field of social impact, it's completely new for Asia. It's completely new for Southeast Asia. It's not new for India. But it's completely new for Southeast Asia. It's also new for Sri Lanka. I think also new for Nepal, of course. For Bangladesh, it's relatively new. Pakistan is relatively new. That's why we went to those countries. And I think, and this comes back to your question, which was already somehow answered, the first question. Nobody would start there. No private investor would, or no fund would start there if the money from the multilateral finance institutions wouldn't be there up front.
Agreed.
So when we think about our $100 million, the first fund which we are doing in Mekong, we are really, really concerned that we get KfW and the different donors, yeah, let's put it that way, plus IFC or DEG and so on, to put money up front first before we say, fund manager, now you can go and to the private sector and ask for some more money. Second point, if we outsource a fund to a private sector fund manager, that's always a contract. And this contract is not ADB determined. This is a partnership, and the fund manager has as much to say as we have to say in this. At the end of the day, of course, we would say if you go non-social, we would not do it. But the terms under which this is constructed is very much a deal between the two, and it is a long negotiation process which can take half a year in some cases. So it is a partnership also between, or longer, yeah. It's a partnership between the development finance institution, IFC or ADB, and the fund manager. Then the question on your, it's a different question, the geographics, yeah. I think every fund is very different. Should be different. This is not always the same. Blueprint has to be also very different. In India, for example, you can expect a higher rate of returns than in the Mekong area. Yeah, so you can probably put up your 10% to 15, yeah? Or, in Mekong, that's 10%. You have different sectors, yeah? We will focus, for example, in India, there are so many private sector funds already there, Avishka, whatever, yeah? And so we will focus, we have made a decision in India not to go along the market, where we could get a high rate of return, but to really look into the niches. What is not so much done yet in India, and where is it not so much done yet in India? So we would, however, never focus in India only on the frontier market of India, let's say the 7 sister states. Also, that is the area where ADB should work, because we wouldn't find a single fund manager which is doing a fund only in those states. They all say, okay, you can give me a mixture, maybe 40% there or 20% there, but then also 30, 40% in Maharashtra and Gujarat and so on and so forth. And we would say, okay, Maharashtra, Gujarat and so on and so forth, but only in the poor areas. Yeah? So it is a negotiation process with the fund manager.
Great, thank you, Armin. So I know we're close to ending here. I'd like to ask the three of our fund managers to give us one thing that you think is critical to your success in the next year in the impact investing space.
That's easy. Yeah, between now, so it's the 26th of June. I'm just going to make a note in my calendar. By the 25th of June next year, we'll have got ADB into Nepal through your fund structure. You look unconvinced.
Well, obviously, Leopard has a similar goal in the Mekong region. But I think that, yeah, attracting more, I think a lot of our job is going to be really educating impact investors in the next year. I find there's a lot of misinformation and also confusion about what impact investing means, and especially what impact investing means in frontier markets. So I think in the next year, we're really going to spend a lot of time, well, that's what we're doing, meeting both individually with people and trying to come to conferences like these, and both finding out from them what they don't know, and also educating them about what both the risks and opportunities are and where the misconceptions of frontier markets. And hopefully the money will come.
Yeah, well, couldn't agree more with Tim. It's all about the commitments. And we're in the process of finalizing a first close for our Indochina fund, 50 million. We're going for a smaller first close relative to the fund size of 250 million, because aside from the IFC, it's largely family offices who will come in as first close investors. And in order to incentivize them to come in as first close investors, we've had to give them first rights of refusal on co-investments. We share with them a pipeline. They like our pipeline of deals. They'll work concurrently on investing directly in the deal as well as the fund itself. So yeah, it's, at the end of the day, it's all about catalyzing the commitments, which in turn, once you have a first close, your more institutional investors, or it's only then that your more institutional investors will start looking at committing to the funds.
Great. Thank you guys very much for your candor and for sharing. And investing in frontier markets is massively challenging for the reasons you talked about. To do it with an impact investing lens is even more difficult. It sounds like without some of the support that we have from organizations like ADB and IFC as being some of those cornerstone investors, it would be even more challenging. So thanks to all of you guys, not only for being on the panel, but for the work that you're doing. So with that, I'd like to say thank you. I think Stephanie has a token of our appreciation, and thank you to the guests. Appreciate it. Have a good rest of the afternoon.